Hi guys, my name's Rob. Welcome to video 28 for the Decentralized Everything Facebook group. I'm not a financial advisor. And for this video, I wanted to talk to you guys about the banking crisis in America and Credit Suisse. And starting off with macro news, the RBA, that's the Reserve Bank of Australia, chose to raise interest rates by 25 basis points on the 7th of March. This was the 10th time in a row that they chose to raise the interest rates. It means that the official cash rate for Australia now stands at 3.5%. So now it's all eyes on the US Federal Reserve. They're going to meet on the 21st of March, and Jerome Powell, he's the head of the US Federal Reserve. He might raise interest rates or he might choose to keep them on hold. They seem determined on hitting this target of 2% inflation, and currently in America inflation stands at 8.5%, so still got a way to go. So this banking crisis all started to unfold on the 8th of March. Within the space of a week, 3 banks have been shut down by the FDIC. They were Signature Bank, Silvergate Bank and Silicon Valley Bank. And I've just learned that Credit Suisse has just been offered a lifeline of $81 billion by the Swiss Central Bank, no doubt all paid for by the Swiss taxpayer. And the one I want to focus on is SVB, or Silicon Valley Bank. The failure of Silicon Valley Bank was the second largest failure in US banking history. Silicon Valley Bank specialized in private startup companies. So these private companies that had lots of money needed somewhere to store their wealth, and so they chose SVB to be their bank. SVB would then engage in a process called fractional reserve lending. Fractional reserve lending means when a bank takes a fraction or a small amount of your deposited money, it then uses that money to invest into other investments which it thinks is going to generate a yield for itself. And in the case of SVB, they chose to invest their customer deposited funds into US Treasury bonds. Traditionally, US Treasury bonds have always been seen as a low risk and safe investment, because the US government is always going to have money to pay back the investors come the maturity of these bonds. However, the bank failed to take into consideration of what happens when interest rates start to go up. Interest rates and US Treasury bonds are inversely proportional to each other. In other words, when interest rates are low, the value of these bonds is high. When interest rates go up, the value of these bonds starts to go down. And in the case of SVB, that's exactly what had happened. They brought up all these US Treasury bonds which were now worth a lot less than what they originally paid for. They were sitting on unrealized losses. They needed liquidity in the system, and they had no choice but to sell out for a loss of $1.8 billion. And so when the technology companies heard about the problems SVB was having, they all started to withdraw their money from the bank all at once, and then you had a bank run. This is a picture of the 1920s, the Great Depression. Same thing, everybody wanted to pull their money out of the bank all at once, but because the banks had done so much fractional reserve lending, there simply was no money in their accounts anymore.